Welcome back, guys. This is part 3 of the video series for beginners to find the undervalued stocks in India and to see how they can value a company. This is a beginner series, so keep that in mind. So the question now is, which is a good company? Which is a good business that I can invest in? A beginner can start with simple ratios which you can easily find, readily available, or you can calculate it yourself pretty much with a calculator. Once you master this, you can look at the intermediate and expert videos that I also have, which will really help you in making your investment journey much more efficient. But until then, you should be able to practice what you have learned. So as long as you have the right mix of stocks, you should be good. That is the reason why I suggested that you should stick to companies that you can follow on a daily basis or even a monthly or yearly basis. You really have some idea about those stocks. That is very important. As long as you know the companies that you are investing in, you have an edge. So that is the reason why you can start investing now. So the first important ratio that we'll talk about is return on equity. You can readily get it in any platform. You can very easily get this, and this is very important. This tells you how much an equity investor will get. So this should be as much as possible, and if it's too low, it's going to be risky. So higher the better. So let's take an example. Let's assume the fixed deposit rate is 8%. We often call this risk-free rate, although Indian rupees has a default risk, but let's forget all those things and concentrate and assume that your fixed deposit is risk-free. That's an assumption right now, and that's 8%. That's an assumption again. So now let's think about how much returns you need to get. Suppose return on equity is 10%. Would you invest in such a company for a 2% gain? 2% is what they make for an equity investor, more than the risk-free rate. So you'll have to demand more to cover your risk. The higher the risk that you feel the company has, the more you should demand. As simple as that. So these ratios are going to be a ballpark, meaning you don't need to be very specific on the percentage. Suppose if you feel the risk is around 3% to 4%, then 8 plus 4, 12 being your lower end of the spectrum. So anything between 12 and maybe 30% is good enough for you. The higher the returns, the more the price could be. Of course, that is where we will come again and look at the valuation. So that will be in subsequent videos. So don't miss out the videos that are going to be following this, and make sure you subscribe to my channel. Until then, bye-bye.